80% of S&P 500 stocks are falling right now, while the index itself is hitting a brand new all-time high. This just happened, and most investors have absolutely no idea what it means yet. Here's what's really going on beneath the surface, and what you need to be thinking about right now. The S&P 500 just printed a fresh all-time high. On paper, everything looks bulletproof, but zoom in, and 4 out of every 5 stocks in that same index are actually declining today. That's not a healthy rally. That's a mirage. A handful of mega-cap tech names are doing all the heavy lifting. We're talking about a market cap concentration so extreme that a few trillion-dollar companies are dragging the entire index higher, while the other 490-plus components bleed out quietly. This is called market breadth deterioration. And historically, when breadth collapses like this, it is one of the most reliable early warning signals on Wall Street. Layer on top of that, today's producer price index data came in hot. That means inflationary pressure is still alive in the pipeline. And that throws a wrench directly into the Fed's rate cut calculus. Ask yourself this: if inflation isn't dead, and the Fed stays higher for longer, what happens to the stretched valuations holding up those mega-cap names? If you're passively indexed to the S&P 500 right now, you feel safe. Your statement says all-time high, but your actual exposure, your real portfolio, may be more top-heavy and more fragile than you realize. But here's what nobody is saying about this yet. The last 3 times the S&P 500 hit a record with this level of breadth deterioration, this exact pattern, the index continued higher for weeks before cracking. The warning sign doesn't mean crash tomorrow. It means the foundation is rotting while the penthouse looks perfect. And when rotation or a catalyst finally hits, the unwind can be fast and brutal. The mainstream narrative is celebrating the headline number. Smart money is watching what's underneath it. 1. Audit your concentration. How much of your portfolio's performance right now is being driven by 5 or fewer names? If the answer makes you uncomfortable, it should. 2. Check earnings support. These mega-cap names have moved on momentum and AI enthusiasm. Confirm they still have hard earnings and free cash flow justifying these valuations, not just hype. 3. Watch the Fed's next signal closely. Hot PPI today means the rate cut timeline just got murkier. Higher for longer is back on the table, and that reprices risk assets fast. New all-time high. 80% of stocks declining. Hot inflation data. This market is sending 3 signals at once, and they are not all pointing the same direction. What do you think this means for your portfolio? Drop it below. This video is for educational purposes only, not financial advice. Always consult a qualified advisor before making any investment decisions.